We all want to buy when prices are low and sell when they're high. So why do most people do the opposite? Why does the average investor panic at the exact wrong moment? Every investor believes they're smarter than the crowd, yet nearly everyone ends up acting exactly like the crowd. This paradox has a name: behavioral finance. It explains the most dangerous truth in the markets. Your brain is not designed to make rational financial decisions. Your brain is designed to avoid pain, seek validation, follow the tribe, react quickly under pressure. These instincts helped human beings survive for millions of years. But in the stock market, these same instincts destroy wealth. Markets don't punish intelligence. Markets punish emotion. This is why even professionals, people with degrees, access to data, and years of experience still fall into the same trap. They sell when prices fall. They buy when prices rise. Not because the chart says so, but because the brain says so. You feel a loss twice as strongly as a gain of the same size. This is loss aversion, your mind's survival system. Example: a $500 profit makes you feel good. A $500 loss makes you feel terrible, almost dangerous. This imbalance changes everything during market volatility. When stocks are rising, your brain says, everyone else is making money. You're missing out. Hurry. When stocks are falling, your brain screams, you are losing everything. Get out. Now, logic gets replaced by emotion. That emotion becomes panic. That panic becomes action. Soon, you're hitting the sell button, not because you analyzed the investment, but because you wanted the pain to stop. Short-term pain destroys long-term wealth. When prices are high, investing feels safe. There's excitement, confidence, celebration. But when markets crash, the same investment suddenly looks like a threat. Nothing about the company changed. Only your emotions did. This is why the market has a cruel design. The safest investments feel scary. The most dangerous investments feel exciting. Your brain sees a falling price as a threat. But in reality, a lower price equals a better deal. This disconnect is the root of the problem. Most people believe they are buying stocks crypto-perpetuatory. What they're actually buying is a feeling: hope, prosperity, excitement, validation. When prices fall, those feelings disappear. Suddenly fear replaces confidence, and selling becomes emotional self-defense. The chart on your screen is not a financial graph, it's a mirror of your emotions. As humans, we are wired to follow others. In ancient times, the herd meant survival. Now, the herd means overpaying at the top and panic selling at the bottom. People don't ask, is this a smart investment? They ask, what is everyone else doing? This instinct creates the same tragic cycle. 1 price rises, 2 everyone buys, 3 price collapses, 4 everyone sells, 5 repeated the smart money. They do the opposite. They sell to the excited majority at the top. They buy from the terrified majority at the bottom. Most investors lose not because they're unlucky, but because they are human. The market doesn't move on numbers. It moves on human emotion. Every bull market begins in silence. A few disciplined investors buy when prices are low, not because it feels good, but because it feels uncomfortable, because value hides where fear is strongest. Slowly, the market climbs, confidence grows, more people join in, then excitement turns into euphoria, the point where people no longer ask questions. Prices rise simply because they have risen. Logic disappears, replaced by one dangerous belief: this time is different. That moment marks the top, not when prices are high, but when caution dies. Then, the cycle flips. A small drop begins. People ignore it. The drop continues. Uncertainty spreads. Panic arrives. The same investors who once believed the price could only go up, now believe it can only go down. The bottom is hit not when prices are low, but when hope dies completely. This emotional cycle keeps repeating. New technology, new companies, new trends, but the same human brain. The market crashes not because of news, but because of people reacting to news. Our brains evolved to react to threats first. News companies know this. Good news is boring. Bad news gets clicks. So the headlines scream, market collapse imminent, billions wiped out. Investors panic. These words trigger the survival system in your brain. You don't think, you react. Suddenly, a temporary dip feels like a permanent disaster. The media profits from fear. Investors lose because of fear. One force drives both reactions: emotion, rationality. Humans hate exclusion. Being left out feels like danger. That's why FOMO, the fear of missing out, pushes people to buy at the peak. When the majority is making money, you feel pressure. If I don't act now, I'll fall behind. But here's the critical truth. If you feel excitement while buying, you are probably late. We see endless proof. People rush into hype assets when they are expensive. People avoid fundamentally strong assets when they are cheap. Because your brain doesn't calculate value, it tracks social proof. What is everyone else doing becomes more important than what is this actually worth. When prices fall, you feel fear. When prices fall quickly, you feel danger. The fear of losing money pushes investors to sell. Not because the asset is bad, but because the pain is unbearable. This is how emotionally driven investors behave. They buy future expectations, they sell current emotions. This is not investing. This is emotional trading. And emotions are terrible at predicting the future. Buying low is hard because fear lives at the bottom. Selling high is hard because greed lives at the top. To make money, you must act against your instincts. But your brain is designed to escape fear, seek comfort, follow certainty, accept popular opinion as truth. So investors chase comfort instead of opportunity. Unfortunately, the best investments are uncomfortable. The worst investments feel safe, which means you are constantly fighting yourself in the market. Here's what separates success from failure. The crowd waits until the price proves itself. By then, it is already expensive. Smart investors act when the price is low, long before confidence appears. The crowd reacts to the present. Smart investors act based on the future, and that is why the crowd buys at the peak, maximum excitement. The crowd sells at the bottom, maximum fear. Success is not about intelligence. It's about emotional discipline. Most investors wait for the moment when everything feels certain, but by the time certainty arrives, the opportunity is already gone. Uncertainty is uncomfortable. Uncertainty feels risky. Uncertainty feels wrong. But uncertainty is also where value is born. When everyone is confident, prices are high. When everyone is fearful, prices are low. The market rewards those who move when others hesitate. Your brain's primary function is survival. It wants safety, predictability, stability. Risk feels like danger. This instinct once protected your ancestors. But in the market, it destroys wealth. You hesitate to buy because the news is bad, people are scared, the price is falling, no one knows the bottom yet. These are the exact conditions that make an asset undervalued. When the world is messy, that is when fortunes are built. People think the opposite of fear is bravery. It's not. The opposite of fear is understanding. When you understand why something has value, market drops don't scare you. Most investors don't understand what they own. They simply follow trends. So when the price falls, there is no conviction holding them in place. They sell, not because the investment changed, but because their emotions changed. Conviction is the shield that protects your future wealth from your present fear. Without it, the market owns you. With it, you own the market. Most people are not bad investors. They are just impatient. They think in daysweek wealthy think in years decadison 2020. You shorten your time horizon. Every dip feels like disaster. When you lengthen your time horizon, every dip becomes an opportunity. Short-term focus equals emotional decisions. Long-term focus equals rational decisions. Time removes the noise. Time reveals the truth. Fast money feels good, and that feeling becomes addictive. The faster you chase profit, the faster fear catches you. Because when your wealth is built on excitement, you panic the moment excitement disappears. Real wealth is slow. Real wealth is boring. Real wealth grows from discipline, not dopamine. Patience is not about waiting. Patience is about not reacting. The market is not your competitor. Other investors are not your enemy. Your emotions are your biggest threat. Because fear does not care about strategy. Greed does not care about logic. Doubt does not care about facts. Your instincts scream, Buy when it's rising, you're missing out. Sell when it's falling, you're losing everything. These instincts once saved your life. Now, they destroy your portfolio. The market pays you for doing the opposite of what your instincts want. But that is not natural, and that is why it's profitable. Successful investors do not feel less emotion. They simply do not act on it. They understand. Volatility is normal. Fear is temporary. Fundamentals matter more than prices. They don't need anyone's approval. They don't need perfect timing. They don't need to feel comfortable. They make decisions based on value, not emotion. Every crash becomes a chance to build wealth. Every panic becomes an invitation to act. Because they know, a long run, the market rewards rationality and punishes emotion. If you want to stop buying at the top and stop selling at the bottom, you must fight the system inside your mind. Because the market doesn't beat you, your instincts do. The goal is not to predict the future. The goal is to control your decisions. Prices change every second. Value changes slowly. The market is a voting machine in the short term, but a weighing machine in the long term. If you make decisions based on temporary emotions, you will always be late. Ask, is the company strong? Is the business growing? Is this asset worth holding for years? If the answer is yes, a falling price is not danger, it is a discount. Most investors panic because they never expect losing. They believe the market should only go up. This expectation is the root of disappointment. Volatility is normal. Corrections are normal. Crashes are normal. But here's the secret. A drop in price does not mean a drop in value. Prepare for volatility before you invest, so you don't panic when it arrives. You will never make a smart decision in a state of fear. You will never see opportunity during panic. Write your strategy while you are calm. Follow it when you are not. Control emotion with principle. Why did you buy? What would make you sell? What is your time frame? When your plan is clear, the market cannot shake you. If something feels safe, it's probably already expensive. If something feels scary, it's probably already undervalued. The crowd buys confidence. The smart buy fear. This is why fortunes are built in recessions, not in celebrations. Your brain wants comfort. Your wealth needs discipline. Your brain wants shortcuts. Your wealth needs patience. Your brain follows the crowd. Your wealth requires independence. To succeed, your mindset must evolve. From reaction to strategy, from emotion to logic, from short-term to long-term investment. Success is a psychological transformation. Most people lose money, not because they choose bad investments, but because they make bad decisions. Every market crash tests your emotions. Every rally tempts your greed. But the rewards always go to those who resist their instincts. Because here is the one rule that never changes. Buying low feels painful. Selling high feels uncomfortable. And that discomfort is where profit lives. If you want to become wealthy, you must stop being controlled by fear and greed. You must learn to think independently. You must embrace discomfort. You must trust your long-term vision. The market doesn't reward the smartest. It rewards the most disciplined. The moment you stop acting like the crowd, you start earning like the few. Master your emotions, and you will master your money.